Listen closely. If you own a home, if you have money sitting in a bank account, or if you hold a retirement account with your name on it, what I'm about to tell you is absolutely crucial. In fact, it might be the most critical thing you hear all year. Right now, as we speak, there are legal mechanisms in place that could literally take everything you spent your entire life building away from your family after you're gone. And you know what the truly terrifying part is? This isn't happening because of some elaborate fraud or a scam. No, this happens simply because of how the American legal system actually operates. Welcome to this explainer. Today we're going to outline the exact traps built into the system, and more importantly, the exact forms and actions you need to take before the end of this week to protect your family's inheritance.
So it's the ultimate question, right? Will your family actually get your money when you pass away? Well, the unfortunate truth is that most people are operating under a really dangerous illusion. You see, they assume that because they sat down, did the responsible thing, and wrote out a traditional will, their loved ones are entirely protected. It's kind of like they think a will is this magical shield that automatically transfers assets to a spouse or children. I hate to be the bearer of bad news, but I need to shatter that false sense of security right now. Relying solely on a basic will is one of the most devastating financial mistakes you can possibly make.
A will carries zero legal weight at a bank counter. Let that sink in for a second. That is a shocking truth that most families only discover when they're actually standing in a bank lobby, grieving a tremendous loss, only to be told they can't access a single cent. You see, a will is really just a letter of instruction addressed to a probate judge. But the bank? The bank doesn't care about that letter. They are only legally obligated to follow the specific contract they have on file, the account agreement you signed when you originally opened the account. If that contract doesn't explicitly name a beneficiary, the bank has absolutely no legal authority to hand your money over to your family. It doesn't matter what your will says, and it honestly doesn't matter what their relationship is to you.
Okay, let's dive right into this. Trap 1. Bank accounts. This first and most common trap catches virtually everyone. If you die without a specifically named beneficiary on your checking or savings account, that money doesn't just automatically go to your spouse or kids. It instantly goes to your estate. And the very moment an asset hits your estate, it triggers a massive legal machine called probate. Probate is the true enemy of a smooth inheritance. It's a court process that opens automatically if no beneficiary is named. And here's what that actually looks like in the real world. In most states, there's a mandatory creditor waiting period built straight into the law. We're talking anywhere from 3 to 6 months. During this massive waiting game, unknown creditors, credit card companies, medical providers, really anyone who might have a claim against your estate gets time to step up and demand a cut of your assets. The court moves entirely on its own schedule, definitely not your family's, meaning your loved ones are completely locked out of those funds while they wait.
And you know, the waiting isn't even the worst part. It's the devastating financial cost. You've got filing fees, required publication fees, executor bond premiums, and of course, probate attorney fees, which by the way, are often calculated as a percentage of your entire gross estate. All of this can absolutely pillage your family's inheritance. To put that into perspective, these costs can easily consume $10,000 to $15,000, or even more before a single dollar reaches your loved ones. And if the estate is complex, or heaven forbid contested, that whole process can drag on for 1 to 2 years.
But here is the crazy part. You can avoid that high-cost nightmare entirely with an immediate $0 solution. It's called a Payable on Death designation, or a POD form. Literally, every FDIC-insured bank is required to offer it. You just walk into your bank, ask for the POD form, and name your beneficiary. That's it. When you pass, your beneficiary simply presents a death certificate and the transfer processes in days, not months. We are talking 0 attorney fees, 0 filing fees, and 0 court involvement. Just keep in mind, every single account, whether it's checking, savings, or a CD, needs its own separate POD designation. Oh, and if you have a brokerage account with stocks or bonds, you use a very similar, completely free form called a Transfer on Death, or TOD designation.
Let's move along and see how this builds. Traps 2 and 3. Your home.
For most of us, our home is our single largest asset. But if it's titled only in your name with no specific transfer mechanism in place, it goes straight into that probate trap we just talked about. This creates a harsh, frozen property reality for your family. Think about it. If the house goes into probate, your family can't sell it, they can't rent it out, and the equity locked inside is completely inaccessible to them for 6 months to well over a year. But here is the real kicker. The bills do not freeze. The mortgage payments still due every single month. Property taxes, they continue to pile up. Homeowners insurance still needs to be maintained, and general maintenance issues still pop up and need to be paid for. Basically, your family is left drowning in bills for a house they aren't even legally allowed to manage.
Now, a lot of folks try to outsmart this by using joint tenancy. Just putting a kid's name on the deed. But actually scratch that. It's a huge risk.
Doing that makes them a co-owner right now, which instantly exposes your home to their debts, lawsuits, or even a potential divorce. A vastly superior option, which is available in over 30 states, is a transfer on death deed. A TOD deed names your beneficiary directly on the property deed while you're alive, but they have absolutely zero ownership rights until you pass away. When you do, the property transfers automatically. No probate, no court, no waiting. The whole shebang simply requires a recording fee of about $20 to $50 at your county recorder. It is hands down one of the most powerful and underused tools in estate planning.
But we need to talk about a third trap regarding your home, and it involves a staggering number, $119,000. That right there is the average cost of nursing home care per year in the U.S. If you end up receiving Medicaid-funded long-term care after age 55, federal law actually requires your state to operate a Medicaid estate recovery program. What does that mean for you? It means your state is legally required to seek reimbursement from your estate after your death. A 2- or 3-year stay in a care facility can easily generate a $200,000 to $350,000 claim against your estate. And since the family home is usually the only significant asset left at that point, the state will forcibly send a letter to your family demanding repayment, often forcing the sale of the house just to recoup those costs.
And this brilliantly illustrates the catch. Because of this recovery program, you're up against a strict federal timeline known as the 5-year look-back period. Federal law specifically prohibits you from just, transferring your house to your kids right before you apply for Medicaid. If you transfer assets within 5 years of needing care, you enter a severe penalty period where Medicaid will flat out refuse to cover you. So planning must happen half a decade in advance. If you even suspect you or your spouse might need long-term care within the next decade, utilizing tools like an irrevocable Medicaid Asset Protection Trust, established at least 5 years early, is absolutely vital. Sitting down and speaking with an elder law attorney half a decade before needing care is, without a doubt, one of the most important financial conversations you can ever have.
Trap 4, retirement accounts.
So a lot of families smugly believe their IRAs and 401ks are perfectly safe because they automatically bypass probate. But you know what? That is exactly where the trap lies. So the crucial point here is anchored in a Supreme Court precedent, Egelhoff v. Egelhoff. The law clearly states that the named beneficiary designation on a retirement account overrules your will, it overrules your divorce decree, it even overrules a direct court order. Let's say you have an IRA you opened way back in 1998, and your ex-spouse is still named as the beneficiary on that specific piece of paper. Guess what? Your ex-spouse is legally going to receive every single dime of that money. It doesn't matter what your current will says. It doesn't matter what your divorce settlement outlined. Courts have repeatedly ruled against surviving spouses and adult children because of this exact issue. An outdated beneficiary form on a $400,000 IRA will legally hand your wealth to the wrong person with absolutely zero recourse for your actual family.
Trap 5. Safe deposit boxes.
Now, what's really interesting about this slide is that it unveils the most surprising trap in this entire explainer. It's a circular legal nightmare that I like to call the safe deposit catch-22. So many seniors do what seems like the safest thing. They lock their wills and property deeds in a bank safe deposit box, and they hand a spare key to a trusted child. Smart, right? Wrong. Federal banking regulations require banks to immediately seal that box upon notification of a customer's death. Your family will be denied access, even if they are standing there holding the spare key. Here is the nightmare loop. Your family needs the will that is locked inside the box to open the probate case, but the bank demands a legal probate order from the court before they will let anyone open the box. The solution for this? It literally takes 5 minutes. Go to your bank today and add your adult child as a joint renter on the safe deposit box contract. By doing that, they retain complete access regardless of your passing, entirely independent of the probate process.
Your weekly action plan.
Okay, we've covered the traps, the legal loopholes, and the devastating costs of just doing nothing. Now let's pivot to your empowerment. These are the completely free fixes you need to execute before the end of this week. Let's get this done. First, go to your bank and file POD forms on every single checking, savings, and CD account separately. Second, contact your brokerage and file TOD forms for your investment accounts. Third, check your local state laws to see if a transfer on death home deed is available, and if it is, get it recorded. Fourth, log into every single IRA and 401k you own today, verify exactly who is named, and update those beneficiaries immediately. And finally, go add a trusted joint renter to your safe deposit box. Seriously, none of these basic steps require an attorney, they cost virtually nothing, and every single one protects something that took you a lifetime to build. I want to leave you with this final provocative thought. Will you spend just 30 minutes this week to protect your family's inheritance?
You now know the risks. You know exactly how the American legal system operates at a bank counter. Don't leave your loved ones fighting a broken, expensive, and incredibly time-consuming system. Take these actionable steps today, take control of your legacy, and ensure that your life's work actually reaches the people you love.